Hi everyone, welcome back to our video series titled Investing 101 with Dr. Peng. Join with me today is Dr. Peng Chen, Senior Advisor to Providend. Hi Dr. Peng, great to have you back.
Hi everyone, hi Isaac, it's great to be back.
In this 5-part series, Dr. Peng and I will be talking about important investing concepts, namely inflation, equity, bonds, gold, and expected returns. In the last episode, we talked about inflation and its impact on society, financial markets, and what we should all take note of. Today's episode will be all about equities. So Dr. Peng, let's begin by what does it mean to invest in equities?
So investing in equities for all of our investors basically means you are directly participating in the company's success or not success in their business activities. So in other words, you are basically sharing the company's profit or loss as an equity investor. When the company does well, they generate a lot of profits, then you also earn part of that profit. But when the company is not doing well, it's generate losses, then your capital also suffer losses.
Right. So if you are an equities investor, essentially you are a shareholder.
You're a shareholder
of the company, and you have a stake. I mean, like if they make profits, you have to share.
Right. That's right.
But of course, if they make losses, you have to bear the loss.
Correct. Very directly.
Yeah. So why is this one of the most common ways of accumulating wealth? I mean, every time we talk about, let's say investing towards retirement, it's always about buying stocks and accumulating as many stocks so that one day when you can hit your financial independence goal, for example.
Sure.
Yeah. So why is it the most common ways to accumulate
Well,
wealth?
if you look at in terms of the asset classes an investor can invest over a longer period of time, there's typically, I would say, 3 large asset classes. One is cash or short-term bonds or deposit. And that offers very safe short-term investment, but really don't offer too much extra returns that on top of inflation, for example. And then you have bonds. Bonds is a fixed income instrument. It offers returns, but also with some volatility or risk here. Equities is the third one, and equities compared to the cash and bonds, they offer actually the highest potential expected return over time, but also with the highest risk. So when you think about this, when you are a long-term investor over time, and you are investing in a diversified way, like Providend prescribed to you, then equity by nature will be a very important instrument because it often offers the highest expected return over a long period of time. And for long-term investor, as you mentioned, investing their retirement portfolio and so on and so forth, we definitely want to help investor capture these extra return that's provided by the companies and the market.
Right. A lot of people view investing into equities as something very risky, right? I mean, some of them, they grew up in families where their parents, lost money investing in equities. So what are some common mistakes that people make when investing in equities? And how should we approach it?
Yeah, so as I mentioned just a minute ago, that investing in equities is in nature more risky than cash and bonds because you're directly participating in the company's operation. You're directly participating and sharing the company's operating results, whether it's profit or losses, right? So by nature, it's more risky. However, that doesn't mean for long-term investors you shouldn't look at it and you shouldn't incorporate it into your portfolio. We also mentioned that equities, by definition, as well as by historical evidence, actually produce much higher returns than cash and bonds. And so for long-term investors, having equities in the portfolio is a very good piece. Now, you mentioned common mistakes. The first common mistakes people make in equity investing is that they concentrate their investing into 1 or 2 companies, basically investing in a very undiversifiable way. rather than investing in a diversified across different industry sectors, across different countries, different equity in one portfolio. When you are investing in one or two companies, the risk of that company does not doing the risk of that company not doing so well become much higher, and it will cause investors to have a higher probability of losing capital and so forth. Now, if you build in a diversified way across different industry sectors, across different sizes of company, across different countries, what you will have is very diversified portfolio. And yes, this portfolio of equity investing may still have some more risk, but it's reduced significantly compared to investing in only one company or a handful of companies.
Right. So some people, they stock pick because they want to get higher returns, and it's true. If you pick right, you get it right, you will get a lot of returns. But as you mentioned, there's a lot of what we call unsystematic risk when it comes to stock picking. So that means, like, for example, you could do all the fundamental analysis in the world, but then a fraud come out in their accounting.
Yeah. So you also mentioned something that I think is worth mentioning to investors. Another issue with investing into these one or two companies typically is that investors rely on forecasting. Basically, they believe they can pick the better performing stock over time than the market. Now, unfortunately, history has shown, as well as if you look at economic theory, has also shown that it's extremely difficult for individual investors to pick which stock is going to do better going into the future, because the market is highly, highly competitive, and it's very hard to gain an edge. And so even though people go into investing one or two stocks believe they might be able to do better than the overall market, but if you look at historical numbers and so forth, the vast majority of investors actually do poorly compared to investing in a diversified portfolio in a low-cost way.
Right. So stock picking, when we look at some of the research paper, if you look at it statistically, they give you kind of lottery-like kind of returns, right? Like, if you get it right, but when we look at individual investors, it's very similar to luck. There's a lot of luck.
Yes.
Luck comes into play.
So there might be I like you exactly right. Like you said, there's a lottery type of effect. There is a very small probability that you might happen to pick the winner, and that gets you very, very good returns. But the larger probability, the vast majority, you actually lose out. And so for individual investors, particularly those unprofessional investors, like most of investors out there, the typical advice is not to try to, pick one or two stocks and try to beat the market. Exactly like what you said. So across the board, even if once you consider, potentially lottery payout, on average, you still lose out. It's very much like you're buying a lottery when you're investing individual stock compared to a diversified portfolio.
Yeah, and this is also compounded by the fact that, the stock market returns is actually driven by a few stocks. So if, let's say, you pick wrongly, which you are most likely going to do, and you don't have the stock that is driving the market's return, for example, your returns would actually drop quite significantly.
That's exactly right, Isaac. I would also add that these few stocks also changes over time.
Yes.
So maybe this year is these few stocks doing really, really well. And if you miss out on these, you're not going to get good returns. The next year, there's going to be a different set of smaller number of stocks that do maybe very well. And so again, for uninformed, unprofessional, typically, the typical investor we're talking about, the best way is to build a diversified portfolio, rely on the long-term risk-return profiles, and capture these long-term premiums that exist in the marketplace with a higher probability of success.
That's a good point you raise. I mean, when we speak to prospective clients, sometimes they'll say, "Oh, why don't I just buy the top 10 companies in the world? Like I can, like your Metas, your Microsofts, your Apples, right? Why don't we just invest in all these?" But we always remind them, it's not about the returns that
already happened.
Yeah. So one example I like to use is like, okay, 20 years ago, what was the top 10 companies in the S&P 500, for example? So if you invested this way, then your outcome would not be so good.
Yes, I remember probably 20 years ago, if you look at the top companies in the S&P 500, I think there's only 2 or 3 technology companies currently labeled as technology. So again, it's very difficult to forecast which company is going to do well, and for that matter, which company is not going to do well. And so for us and for most investors, the best way is to diversify and focus on the more reliable premiums that exist long term.
Right. Okay, so now that we know that we have to diversify, and to get reliable returns, what are some things to take note of, when investing in equities, like in time horizon, for example, or how do we do it? Should we globally diversify? Should we just buy, say, the Singapore market or US market?
That's a very good question. First of all, I think we use the term diversification or diversify many, many times. Yeah. And diversify, first of all, means diversify across large number of stocks. And so if you look at the Singapore market, even though Singapore is an advanced economy, we have a lot of good companies and have a relatively vibrant stock market, but globally speaking, Singapore has a very small stock market. And so if you just focus on investing in Singapore, you're actually missing the vast majority of good companies, and for that matter, are the opportunity to participate in these companies' economic activities, the profits, and so on and so forth. And so when we look at it, the first thing we want to do is make sure we diversify across industries and across countries. And that means diversify outside of Singapore for Singapore investors. For U.S. investors, that would also mean diversify outside of U.S. Companies, and make sure that you are participating in the global economy and participating in the diversified way.
Right. We have a lot of people that come to us and say that, the U.S. markets, right? Let's say we look at the S&P 500 index, has done really well,
right.
Especially in the past decade, right?
Yes.
So and when you look at the names in the S&P 500, right, it's companies such as your Apples, your Nvidia, your Google, your Alphabets, right? Yeah. So why should and these are behemoths, right? Mega cap companies, and they have businesses all around the world. I mean, in Singapore, you have Apple stores.
That's true.
All
That's
around
true.
the world.
Yep.
And so what's the argument for diversifying globally if this is the case?
Sure. I think what you said is absolutely true. U.S. Being the world's largest economy, represent about 25% of global GDP. In terms of stock market, it's actually even bigger. It represents over 50%, roughly 55% of global market cap, if you look at the companies listed in the U.S. stock market. And if you look at the S&P 500, roughly 40% of its revenue and profit and so forth are generated outside of the United States. So U.S. market is in terms of any country stock market, is the largest and is also the most diversified stock market, country by country comparison. But that doesn't mean that you should only invest in U.S. So even if you invest in the U.S., it represents about 55% of global market. You're still missing 45% of market. So, for example, there's many companies in Asia, for example, does very, very well. Or we would have missed out Samsung Electronics, BYD, Taiwan Semiconductor, just to name a few, right? And if you look at European companies, then you would have missed out to the luxury good companies that's also doing very well.
Nestle.
I'm not saying that just to pick the companies does well. My point is that there's many other countries and many companies and many sectors that these other countries that would have a better advantage potentially. And so even for a U.S.-based investor, that they should invest outside of U.S. and look at globally perspective.
Yeah, when we don't even have to look that far back into history when we look at S&P 500 returns, right? From 2000 to 2009, it had a negative return, right? So even
Correct.
after investing,
it's called the lost of 10 years.
The lost decade, right?
The lost decades, yes.
Yeah. So it's just it's not too long ago, right? But imagine you are investing and after 10 years you're still in the red, right? And during this period, I believe emerging markets was doing really well.
Correct. So these are also market cycles, economic cycles. So sometimes when U.S. does well, other countries may not do as well as we look at the past 10 years and so forth. But in some other time periods, other countries could do well and U.S. may not do well. And this is, again, going back to the power of long-term investing and diversification. Standing here today, we really don't know. I mean, nobody knows, which country, which sector, which company is going to do well. And again, the most prudent way, the best way to achieve, your expected return with a high probability is try to diversify on the equity side.
Yeah, so it's back to the point on reliability.
Yes.
Right. So if you choose the right country, again, like the same thing with stocks, right? So if you choose the right country and it for the next 20 years or 30 years, you turn out to be right, of course you're gonna get pretty good returns. However, when it comes to investing, especially your serious money, right? We're not talking about like
play money.
This is your retirement money. At Providend, we always emphasize that we go for the most reliable kind of returns.
Yeah, another way to look at it, if you look at the Providend global portfolio, we invest in roughly 40 to 45 different countries globally, and that include developed market as well as emerging market. And so on any given year, if you rank the countries in terms of which market is going to do, you can see that no country consistently coming on the top. And so that again point out the importance of diversification, and that will help you, give you the best risk-return trade-offs over time.
Okay, thanks, Dr. Peng. So lastly, when we look at indexes, right? Indices like the MSCI All Country World, or let's say the S&P 500. There's we call this, if you invest in this index, we always say it's passive investing, meaning there's no fund manager that will pick the stock and all that. So who decides then which companies are in the list, and why does this always change even though there's no fund manager?
Right. So when it comes to index, these are produced by various index providers, and it's typically referred to as passive investing. Basically means that these index providers are not necessarily trying to forecast or predict which company is going to do well, which stock is going to do well, which is going to provide better returns. They're basically come up with a set of rules that are based on company characteristics that build the index. And the most popular index that you mentioned, whether it's the S&P 500 or the MSCI All Country, are basically what we call market cap indexes. So they basically look at, on any given day, any given time, the company's market cap as a percentage of the overall market, or the index they're trying to construct, and then build the index that way. Now, occasionally they would review the index and say, okay, which ones should fit in, which ones shouldn't fit in, to try to achieve industry diversification. So, for example, S&P 500, what they try to do is also, besides institute this market cap rule, they want to look at the top 500 companies in terms of market cap. But they also try to make sure that all the industry sectors are somewhat represented. And so they would then decide, okay, maybe we need to make sure that this industry sector is represented well, or this industry sector maybe we don't need as many representations. So there's minor adjustment, but for the most part it's based on market cap, and the market cap is basically the market's price on the company. And so it reflects the investors, overall investors' view on how much this company is worth in the marketplace. And so all of this considered, as you mentioned, there are some changes from time to time because the market cap does change.
Yeah.
In the market. And then secondarily, certain indexes, they try to make sure there's good representation. But despite these changes or rules, or I would say, adjustment by the index committee, overall these are by and large still very passive, very objective indexes. And the biggest difference, as I mentioned, it doesn't reflect anybody's particular views on the market, on the company, or and so on and so forth.
It reflects the views of the rather collective wisdom.
Collective
all
wisdom.
The market
Exactly right.
participants.
Exactly right.
Okay, so to summarize what we have shared today, I mean, don't diversify across different companies, industries, countries.
Yeah.
Right? So now, and let's say we do that.
Right.
We do that. Does that mean that is that all? I mean, like when we look at the time horizon, for example,
Sure.
Right? Let's say we diversify globally across all the different sectors and industries. How much time do we need to capture the equity premium?
That's a very, very good question. So we talked about that. For individual investor, when they come to investing, typically there are three largest asset classes: cash, bonds, and stock. And we talk about stock being the highest risk, but also offer the highest potential returns. Now, to capture that returns, not only you need to diversify across different companies, industry, and country, oftentimes you need to make sure you hold the portfolio for a period of time. And as we mentioned, even though it's not a guarantee that you hold long period, that it will result in good, nice returns, but it does reduce the chance that you get really bad outcomes. And so normally when we look at, historically speaking, we would want to make sure investor, when you're investing in a predominantly stock-based portfolio, overall, you want to make sure you hold the stock portfolio for a relatively long period of time. Now, what does that mean, relatively long? So typically it means you hold it to one complete economic cycle or one complete market cycle. And these are relatively goes hand in hand, and that means roughly 7 to 10 years at a minimum. So you want to make sure when you go into an equity heavy portfolio, you at least have an investment horizon of 7 to 10 years or longer.
Right. Okay. Thank you so much, Dr. Peng. So that's all for this week's episode. Thanks once again for your time, your insights today.
Thanks, Isaac, for having me here, and I'm really glad to talk about these. And so hopefully see you next time.
Yeah. Okay, to all our listeners, we hope that you enjoy, or rather you found this discussion useful in understanding what it means to invest in the equity markets. If you like this episode, please subscribe to our channel so that you don't miss out on the next few episodes where we will be talking about bonds, goal, and expected returns. So as always, thank you for listening, and I'll see you in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.